There is a theory in chaos mathematics called the butterfly effect. It posits that a butterfly flapping its wings in Tokyo can cause a tornado in New York in the high-stakes world of global finance. This is no longer just a mathematical theory. It is a cold, hard mechanical certainty. While the mainstream media remains pathologically obsessed with the Federal Reserve's next move, the theater of the U.S. election cycle, or the latest geopolitical skirmish in Venezuela, they are blind to the single most dangerous chart in the history of modern finance. This chart has just shattered a 25-year trend, signaling the absolute end of the free money era. I am talking about the Japanese government bond yields, specifically the 30-year yield, which has just surged to a staggering 3.5%. To the average person, these are just boring numbers on a screen, but to the institutional plumbing of the world, this is a catastrophe. For 2 decades, Japan has acted as the global ATM, printing unlimited yen and keeping rates at zero. But today, that ATM is not just closed, it is demanding its money back. The yen bomb has detonated, and the timer just hit zero. To understand why 3.5% represents a global disaster, we must pull back the curtain on the game Wall Street has been playing since 2001, known as the yen carry trade. Imagine you are a veteran hedge fund manager in New York. You want to buy Nvidia, Bitcoin, or US Treasuries, but you don't want to use your own capital. You want leverage. You look for the cheapest loan on the planet, and you find it in Japan, where the Bank of Japan has maintained interest rates at zero or even negative for years. You borrow 1 billion yen at virtually no cost, convert that yen into US dollars, and buy assets yielding 5% or 10%. You pocket the difference as pure profit. This free money engine has pumped trillions of dollars into Western markets, acting as the primary liquidity driver for the massive asset bubbles we see today. However, this entire mechanism relies on one fatal assumption, that Japanese rates will stay low forever. That assumption has just evaporated. The Bank of Japan has officially lost control as inflation forces them to tighten their grip. When the 10-year yield crossed 2.13% and the 30-year hit 3.5%, the golden number was breached. Japan is a nation of savers, with massive pension funds and life insurers that have been forced to invest offshore for decades because they couldn't find yield at home. They are currently the largest foreign holders of U.S. debt, owning over $1.2 trillion in treasuries, but now they can get 3.5% risk-free at home in Tokyo without any currency risk. The Great Repatriation has begun. Japanese investors are selling their U.S. bonds and pulling their capital back to Tokyo. This creates a massive liquidity vacuum in the heart of the Western financial system. When the largest buyer in the room leaves, the floor falls out, and that is exactly what we are witnessing right now. This is not merely a Japanese crisis. It is a global margin call that is about to ripple through every asset class. When the yen strengthens and Japanese rates rise, those trillion-dollar carry trades become toxic. Hedge funds that are over-leveraged must sell their winners, their U.S. tech stocks and their crypto, just to pay back the yen they borrowed. This creates a wave of mechanical selling pressure that has absolutely nothing to do with economic fundamentals or corporate earnings. We are entering a deleveraging event that will expose the shadow casino of the global banking system. The notional value of global derivatives tied to interest rates is estimated to be near $1 quadrillion. Most of these are bets that rates would stay stable. As Japan pushes global yields higher, these derivative bets are blowing up, creating a credit contagion that will force the Federal Reserve into a desperate corner. The United States government is currently running a deficit of $2 trillion a year, requiring a constant stream of foreign buyers to keep the lights on. But with China selling and Japan repatriating, the U.S. Treasury market is facing a terminal collapse. To prevent interest rates from spiking to 7% or 8%, which would make the U.S. government insolvent, the Federal Reserve will be forced to implement yield curve control. They will have to become the buyer of last resort, printing infinite new dollars to buy the old bonds that Japan is dumping. This is the ultimate surrender. It means the central bank has prioritized the solvency of the government over the value of the currency. Once the market realizes that the supply of dollars is going vertical to save the bond market, faith in fiat currency will vanish. This is the precise moment when capital flees from the leveraged paper economy and into the real economy of hard assets. Silver is the primary beneficiary of this systemic shift because it sits at the intersection of monetary history and industrial utility. Unlike a treasury bond or a bank deposit, silver has no counterparty risk and cannot be diluted by a central bank printer. In the initial phase of this liquidity shock, everything gets sold, and we may see silver prices dip as traders cover their margin calls. But once the smoke clears, the rush for safety will be unprecedented. We are looking at a dual driver for silver: the Fed's desperate printing to absorb Japanese selling, and a surge in industrial demand from a manufacturing-heavy Japan that now has a stronger currency to buy raw materials. This is not a speculative rally, it is a monetary flight to quality. We are repeating the cycle of the 1970s, where bonds crashed and precious metals went to the moon. But this time, the debt levels are 10 times higher and the exit door is much smaller. The yen bomb is the pin that has finally popped the global debt bubble, marking the definitive end of the era of cheap money. We have moved past the point of speculation and into the era of a violent global repricing. History gives us a clear roadmap for what happens next. In every major crisis, from 2008 to 2020, the response has always been the same: massive liquidity injections. When the Fed eventually surrenders to yield curve control to save the banks, silver will not just rise, it will explode. We have established conservative price targets based on the gold-to-silver ratio compression. At a $4,500 gold price, a return to the historical ratio of 41 puts silver at $112. In a true panic, similar to the 1980s, that ratio could collapse to 15:1, sending silver toward $300. However, you must be prepared for the journey. The path from $70 to $300 will not be a straight line. It will be a jagged, violent trajectory filled with shakeouts designed to scare you out of your position. The smart money wants your physical metal so they can cover their paper shorts as the system breaks. Do not let the volatility of the carry trade unwind steal your future. If you own the metal and avoid leverage, you can ride out the storm while the fiat system burns. The yen is moving, the bonds are breaking, and silver is the next domino to fall. Hold fast, because the great repricing has only just begun. The global ATM is out of order, and the only currency that will matter is the one you can.
They want you fixated on gold. They want you dazzled by the record-breaking numbers on tonight's financial news. It is a perfect magic trick. But while the crowd is busy chasing the glitter of gold, down in the vaults of the London and New York exchanges, a real bleed is taking place. Silver isn't just rising in price, it is physically vanishing from the system. This isn't about numbers on paper. The world is running out of the one metal that powers the green economy in the modern war machine. Today, I won't give you empty hype. I'm going to open the macro data files and analyze supply and demand to prove to you why we are facing the decade's largest structural imbalance. Welcome to the Strategy Report. Let's get into the data. To understand why silver is the most important story right now, we need to ignore the short-term noise and look at the big picture. Against a backdrop of escalating geopolitical tensions and global monetary policy uncertainty, the precious metals complex has recorded superior growth. However, there is a distinct divergence. While gold is successively setting new all-time highs due to frantic buying from central banks, silver is quietly forming a much more strategic price setup. My thesis today is clear. Silver is currently irrationally undervalued relative to its fundamentals. Let's start with the first macro factor, the safe haven role. Tensions in the Middle East and Eastern Europe are no longer isolated news events. They have become persistent risks. In this environment, smart money always seeks out hard assets. Although gold is the top choice for sovereigns, silver plays the role of a high beta safe haven. History proves that when gold rises 1%, silver tends to rise 1.5 to 2%. The second macro factor is monetary policy. The market is pricing in the probability that the Federal Reserve will be forced to ease to support the economy. When the tightening cycle ends and the dollar shows signs of weakness, that is the strongest tailwind for silver prices. But that is just the tip of the iceberg. The real story lies in the next section: supply and demand. Unlike gold, where most supply is stored in vaults and recirculated into the market, silver is an industrial metal that is consumed and extinguished. This is the key point that Wall Street often ignores. On the demand side, we are witnessing a shock from the energy transition. Silver demand no longer depends on jewelry or photography like in the last century. The current driver comes from the green economy. The solar industry is booming with next-generation battery technologies like TOPCon and HJT, which require a much higher silver content to achieve optimal conductivity. Add to that electric vehicles and artificial intelligence. You cannot run an AI data center or a guided missile system without high-quality semiconductor components, where silver is an irreplaceable material. But on the other side of the scale, supply is facing serious challenges. Here is a fact few people know. About 80% of global silver supply is merely a byproduct of copper, lead, zinc, and gold. What does this mean? It means silver supply is extremely inelastic. Mining companies cannot simply increase silver production when the silver price rises. They only dig up more silver when the demand for copper or zinc increases. Furthermore, we must address the CapEx crisis, capital expenditure, in the mining sector. For the past decade, under pressure from ESG mandates and low commodity prices, mining companies have drastically underinvested in exploration and development. They have prioritized stock buybacks over digging new holes. Here is the harsh reality. It takes, on average, 10 to 15 years to take a mine from discovery to production. Even if the price of silver doubles tomorrow, new supply cannot come online until the mid-2030s. We are facing a supply cliff that no amount of money can bridge in the short term. The geological reality is colliding with the industrial necessity. Data from the Silver Institute shows the market has experienced a supply-demand deficit for 4 consecutive years. This deficit is gradually eroding the visible stockpiles at COMEX in London. We are draining the final bars out of the vaults. So where is the opportunity? A professional investor doesn't look at price, they look at relative value and market structure anomalies. The East-West arbitrage. There is a critical anomaly occurring right now that demands your attention: the Shanghai premium. While Western markets trade paper silver, futures contracts, to set the price, Eastern markets, specifically the Shanghai Gold Exchange, are trading for physical possession. We are seeing silver trade in Shanghai at a premium of 10% or more over the COMEX price in New York. This arbitrage window is a flashing red signal. It tells us that while Western hedge funds are shorting paper contracts, Eastern buyers are draining physical inventory. The smart money in the East is willing to pay significantly more to secure the metal now. This flow of metal from West to East is tightening the physical float to a breaking point. When the COMEX vault runs dry, the paper price will have no choice but to gap up to meet the physical reality. Now, let's look at the gold-silver ratio. Currently, this ratio is hovering around 85. That means it takes 85 ounces of silver to exchange for 1 ounce of gold. Let me give you some context. The average in the 20th century was only about 47. This indicates that silver is absurdly cheap compared to gold. According to the law of mean reversion, if the precious metals market continues its uptrend, silver has an upside potential many times greater than gold to narrow this gap. Regarding market sentiment, the Commitment of Traders report shows that large funds are holding net long positions, but they have not reached extreme levels. This is very positive. It means the market still has plenty of room for new money to enter without fear of being overbought. However, as responsible investors, we must look at both sides of the coin. What are the risks? The biggest risk is a full-blown economic recession. Since over 50% of silver demand comes from industry, if factories close and manufacturing demand drops, silver prices will face pressure in the short term, unlike gold, which is a pure defensive asset. Additionally, if the Fed maintains higher for longer interest rates to fight inflation, the strength of the dollar will be a headwind hindering price appreciation. To summarize, based on the convergence of macro and micro factors, my strategic view on silver is bullish in the medium to long term. We are standing before a perfect storm. Monetary demand is supported by geopolitical instability. Physical demand is driven by the irreversible green industrial revolution. Meanwhile, supply is constricted by a decade of underinvestment and cannot react quickly. We are witnessing a gradual decoupling between paper silver prices and physical reality, evidenced by the widening Shanghai premium. As stockpiles continue to drop to alarmingly low levels, the pricing mechanism will be forced to reflect the true scarcity of this metal. My advice? Watch the inventory data and the arbitrage spreads closely. Do not let short-term price fluctuations deceive you. When the monetary system shakes, gold is the shield, but silver is the sword. Thank you for watching this report. See you in the next analysis. Stop. Take a breath. Look at the markets around you. Nvidia is breaking records. Bitcoin is making headlines. The S&P 500 is partying like there is no tomorrow. But amidst this cacophony of greed, there is a silence, a heavy, unnatural silence surrounding one specific asset. I'm talking about silver. To the untrained eye, the silver chart looks dead. It looks stable. It looks like an asset that time forgot. But if you have been in this game as long as I have, you know that stability is a lie. In the financial jungle, when the water recedes from the shoreline, it doesn't mean the ocean is calm. It means a tsunami is building. Wall Street wants you to look at the price tag, let's say $30, $32, or whatever the algorithm decides today, and believe that is the value. They want you to believe that silver is abundant, that it's just a pet rock for conspiracy theorists, but they are lying to you. We are witnessing one of the greatest misdirections in financial history. While the paper price on your screen is being suppressed by high-frequency trading algorithms and massive short positions, the real metal, the physical bars, the coins, the industrial grain, is vanishing. It is being drained, it is being hoarded, and it is happening right under your nose. This isn't a market correction. This is a crime scene. And today, we are going to walk through the yellow tape, ignore the mainstream media's distraction, and look at the blood on the floor. Let's put on our forensic gloves and dig into the mechanism of this fraud. We need to talk about the rehypothecation of silver. It's a fancy word, isn't it? But in simple English, it means selling what you don't own. If you look at the COMEX, the Commodity Exchange, or the LBMA in London, you will see millions of ounces of silver being traded every single day. Volume is high, liquidity looks deep, but here's the dirty secret they don't want you to know. For every single ounce of physical silver sitting in a vault, there are upwards of 200 to 300 paper claims floating around the market. Think about that. 200 people hold a piece of paper that says, "I own 1 ounce of silver," but there's only 1 ounce in the vault. What do you call a bank that lends out the same dollar to 200 people? You call it a Ponzi scheme, but on Wall Street, they call it futures trading. My team has been tracking the registered category in the COMEX vaults. Registered means silver that is actually available for delivery, silver that can be bought and taken home. That number has plummeted to historic lows. It is hemorrhaging. The vaults are bleeding out. So who is selling? The commercials, the big bullion banks. They use massive spoofing orders and naked shorts to slam the price down every time it tries to rally. Why? Because if the price rises too high too fast, their short positions will blow up. They are trapped in a cage of their own making. They must suppress the price to survive. But here's the catch. You can suppress the price of paper indefinitely. You can print unlimited contracts, but you cannot print metal. Eventually, the physical buyers, the people who want the actual bar, not the paper receipt, will show up at the counter, and when they ask for their silver, the teller is going to look at the empty vault and panic will set in. Now let's zoom out. Why is this shortage absolutely inevitable? Why is this different from 1980 or 2011? Because the world has changed. Silver is no longer just money. Silver is the strategic imperative of the 21st century. We are moving into an era of the electrification of everything, and physics dictates one simple truth. Silver is the most conductive metal on the periodic table. You cannot cheat physics. Solar energy. The world is racing toward net zero. Solar panels are being installed on every roof from California to Shanghai. Newer, more efficient panels, like TOPCon technology, use twice as much silver as the old ones. The solar industry alone is swallowing nearly 20% of the annual mining supply. The AI revolution. You think artificial intelligence is just software? Wrong. AI runs on chips. It runs on servers. It runs on massive data centers that require complex electronics. Every single connection, every switch, every motherboard contains silver. The military-industrial complex. Do you think that Tomahawk missiles and smart drones being used in global conflicts run on copper? No. They require the highest quality, most reliable conductor, silver. Here is the connection that should keep you awake at night. Silver demand is inelastic. What does that mean? It means Apple doesn't care if silver is $30 or $300 an ounce. There is only a tiny amount of silver in an iPhone, but without it, the iPhone doesn't work. So if the price triples, Apple must pay it. They cannot stop production. The same goes for Tesla. The same goes for Raytheon. We have a situation where demand is non-negotiable and growing exponentially, while supply is stagnant. Mine production is flat. Grade quality is dropping. It takes 10 years to bring a new mine online. We are entering a structural deficit. We are burning the furniture to heat the house. The surface stockpiles are gone. And now, nations like China and India are quietly sweeping the market, importing massive tonnage, draining the West of its real wealth. They know what's coming. They are exchanging their paper dollars for hard assets before the music stops.
So, how does this movie end? It doesn't end with a whimper. It ends with a violent repricing. We are approaching a singularity point, the short squeeze of the century. Imagine this scenario. The Federal Reserve, panicked by a recession or a banking crisis, cuts rates aggressively. The dollar index, DXY, begins to crack. Suddenly, the safe haven trade wakes up. Investors rush to buy silver. But this time, when they call their broker to buy physical metal, the broker says, "I'm sorry, there's a 6-week delay." Then it becomes a 3-month delay. Then it becomes unavailable. Premiums on physical coins will skyrocket to 50%, maybe 100% over the spot price. The disconnect between the fake paper price and the real street price will become undeniable. At that moment, the industrial giants, the Samsungs, the LGs, the solar manufacturers will panic. They won't buy to speculate. They will buy to keep their factory doors open. They will bypass the futures market and go directly to the mines, offering double or triple the market rate to secure supply. The paper market will break. The COMEX may declare force majeure, a legal clause that allows them to settle your contract in cash because they don't have the metal to give you. They will hand you worthless dollars and keep the silver. This is the super spike. We could see silver move $5, $10 in a single day. The gold-to-silver ratio, which is currently sitting at historically absurd levels, around 80-1 or higher, will collapse back to 40-1, maybe even 20-1. That means silver will outperform gold by a factor of 3 or 4. I don't predict the future. I analyze the crime scene of the present so you can prepare for the verdict.